Contributed capital. Let's take a look at the ratios that tell you about the financial health of contributed capital. And there's 4 of them that I want you to be aware of. The first one is dividends per share. And that says for each share of stock you own, what is your dividend? And most of the time that's computed for you, but let's see where it comes from. Dividends declared divided by the shares outstanding, because remember, only outstanding stock gets the dividend. Treasury stock does not get a dividend. So that would give you your dividend per share. Now what's interesting about this is the dividend yield. The dividend yield basically says what is your dividend per share and divide that by the market price of the stock. And by getting that, you'll get a percentage, and that percentage is your yield. In other words, it's kind of like you could compare it to, I could take this money, put it in my savings account, and earn interest of a certain percentage. Or I can take this money, invest it in the stock market, make this kind of dividend on it. What is my percentage? Am I better off playing the stock market or putting it in the bank? Of course, that will be determined based on how much risk you're willing to live with as well, and other factors. But the dividend yield gives you a percentage. What kind of return are you getting on this investment you have in the stock market? Earnings per share. Earnings per share will be computed and disclosed on the income statement. But briefly, because you'll see it more next chapter, it's the net income divided by the shares outstanding. Net income divided by the shares outstanding. Now, it's a lot more complicated than this in real life, and we'll end up with the weighted average common stock shares outstanding, but we'll save that for next chapter. The reason I wanted to briefly tell you about earnings per share is there's something called the PE ratio, the price earnings ratio. And this is an important ratio that investors and analysts look at. It's the market price of the stock divided by the earnings per share. In other words, what is the stock selling for versus what kind of profits does each share of stock earn? And you can see how much risk is involved. So you'll see stocks with high PEs and stocks with low PEs. And low PEs means that there's quite a bit of earnings per share relative to the stock price. Now let's take a look briefly at exercise 3. And in exercise 3, they asked us to find the dividend yield and the PE ratio. And the facts of the situation are this. The market price of the stock at the end of the year is $66. It paid a dividend this year of $2, and the earnings per share are $4.40 per share. So if I was going to find the dividend yield, I would take the dividend for the year, which is $2, and divide it by the market price at the end of the year, which is $66, and I can see that this stock has a yield of about 3%. So I'm earning about 3% of the price of the cost of the stock, price of the stock. 3% of the price of the stock is the dividend. Is that good or bad? It depends, doesn't it? PE ratio, price earnings ratio, that's where we take the price of the stock, which at year end is $66, and I'm going to divide it by the earnings per share, and the earnings per share are $4.40. So I can see that 440 into 66 is 15.0. In other words, the stock is selling for about 15 times its earnings. Is that good or bad? Again, it depends. You need something to compare these ratios to, at least to your expectations, what the market is doing, what the comparables are doing, in order to really render a judgment about them. But that's the basics on how to do the math.